We're going to get started today and dive into some really unique, nice option income selling strategies for you income seekers. So again, thank you so much for being here. I love these Saturday events. You know, the markets are closed. We can kind of kick back, talk the markets. And today we're going to, dive in, like I said, into 7 different option income strategies and a couple of my favorites that I really like. So grab your notepad, your beverage, and let us get started. So a little background on my trading journey. I started back in the 80s on the oil side. I was fortunate enough to get in with a company called Coastal Corporation. They actually, at that point in time, they had a training program that would train you how to trade at that time oil and oil products. So I was able to get into that program, and that's where my career started. So they sent me down to one of the refineries down in Corpus Christi, Texas, for about 4 months, which was fantastic. Kind of learned the fundamentals of how bringing the oil in, putting it through the refiners and processing it. So spent time there, kind of getting my feet wet as far as what oil is and how it comes in and makes products. Then they put me into their tankering department, chartering ships and doing operations, which was fantastic. And then finally got into the cargo trading desk. So went out. They sent me out to Singapore for a couple of years and spent time out there trading products. And the Asian cruise, a fantastic experience there. If you ever get a chance, make sure to check out Singapore. And then mid 80s, went to work for a company called Transworld Oil. At that time, they were the largest oil trading company in the world. It was Transworld, Fibra, and Mark Rich, and spent 17 years there. About 15 of those years out in Bermuda, where we had our corporate headquarters, ran the international trading desk there for 10. So that's really where I started getting involved in options. So we started trading options and selling option premium on cargoes of crude oil back in 1987. So that was my first taste of options, and I've never looked back. And so we're going to talk about some selling income strategies here today. So the following presentation is purely for educational purposes. Any stocks, options, futures, or ETFs mentioned does not constitute advice and should not be construed as a recommendation. Can everybody hear me okay? Mic test. Okay, testing 1, 2, 3. Can you hear me? Okay, sound is good. So maybe go, if you're having some audio issues, go out and come back in. All right, well, thanks. So let's get started. So when you look at option income selling strategies, what they do is they uniquely enable you to enhance returns by the way of combining long options and short options so that you can generate income on a regular basis. So, income option strategies are typically short in duration, whereby the option premium you sold either on a weekly or monthly basis will help you to generate, significant percentage returns on the underlying security, even if it hasn't moved. So you're, basically collecting rent on your security, like your rental income properties. If you have any, you get that rent every month. So that's a really nice thing to, put in the pocket. So let's take a look at the steps that kind of make these things work. So step 1 is to know how to sell time. The secret of income using options really is understanding time and also the implied volatility and how those two work, to make these types of strategies work. But the first one, the big one, is these, time. So when we're trading options and option strategies designed for income, the most important option factor is to understand that concept of time and the impact that it has on the price of the option. So we can, basically trade time by selling it to take advantage of option time decay, or what we call time value. So when we look at this pricing component, what it is, it's basically the time value is your extrinsic value of your option. So it's the premium that the trader or your investor is going to willing to pay over the current exercise value, that intrinsic value, based on the option's potential to increase in value before it expires. So the change in the value of your option based on this time decay can be measured by the Greek we call theta. And so time decay increases as expiration draws near, and it's going to decrease as options go more in the money or they go more out of the money. So that less intrinsic or less extrinsic value. Now, when we look at option theta decay, it really accelerates during the last 30 days of your option cycle, and that's where it really soars. So that's kind of call it turbo time decay. So when we look at this kind of graph of time, you can see how it's illustrated. So if we go out in time, say 120 to 90 days out, the theta decay is very, very small. It barely, affects the option when you're further out in time. But basically, it starts to really tail off when you get about 30 days off to your expiration or day zero. So then it really starts to accelerate. And so then we can play these weekly options. And with certain ETFs, we can even play daily options. So we can really take advantage of that time premium decay that make these strategies very unique. So step two is then knowing how your option pricing works. So when we look at the value of the option, what it comes down to is your time value component times the implied volatility times the intrinsic value, which is the underlying security value. Now, once we know these variables, then we're going to be ready to price out the option, know what that option premium should be, and then have an idea of what kind of option strategies that we want to put on. So looking at this table, it kind of really illustrates this time decay component again. So when we look at the value of your option, again, it's going to be your time value times the implied volatility times the underlying security value, the intrinsic value. So we're going to leave this constant so you can just see how time and implied volatility affect the price or premium of your option. So the first day of the week, most of the big option companies or stocks are going to have weekly options. So the first Thursday, every Thursday, we'll have a new weekly option series. And on that first Thursday, that first day, we have 100% time in that option as it starts out. Now, even here, so I just plugged in a number of 300 for the implied volatility. So you can see the time value of 100 times 3. We'll leave this constant. And so your option premium is $300. Now, here's the big thing. When you have your time value, just let's say you come back in Monday after the weekend. So you can see that time decay is hitting every day, even over the weekend. So we come back in on Monday, 50%, half that time decay is now gone, right? It's already eroded, it's already decayed. And even in this example, if we spiked up implied volatility to put a number in here at 800, you can see it barely pushed the premium of your option up to 400. So let's say the implied volatility though dropped, and now let's say it's 200. So you can see the value of your option would only be $100. Okay, so you can see the big impact that time has. And then the other component that also has a major impact is implied volatility. And at the end of your life cycle or option cycle, they both these components go to zero. So when we're selling option strategies, we're selling both time and implied volatility, and those two components at the end of the day at expiration are going to go to zero. So that's where we can take advantage of collecting that income from the premium we receive on selling those options. Now, the next thing to understand is trading the probabilities. So this is what I call the market maker secret. It's what the market makers, the professional money, they don't want you to know. All right, so when we look at option markets use mathematical market probability statistics for pricing out the movement of your option to its expiration. So by knowing the probability of your underlying security finishing within a certain range at expiration becomes key to then determining what options you want to buy or sell, and then what option strategy to use. So this forecast is what we refer to as the implied move or the expected move of your stock or security. So this implied move, basically what it is, it's an estimate of a plus or minus 1 standard deviation move of the underlying security by its expiration date. So that's where we can really start. We can look at the probabilities based on these standard deviation. Now, when we look to selling an option out of the money, typically we'll look to sell, start with looking out of the money about 1 standard deviation. All right, so if you look at 1 standard deviation, what that basically involves or comes back to is a probability trade. So when we look at the delta of an option or option delta, the delta equals basically is what it's equivalent to 100 shares of stock. Okay, so if you have a delta of +1, that's going to be equivalent like you having 100 shares of stock. Now, if you were to sell a 16 delta, something like this outside point of a 1 standard deviation move, which we'll go over a little bit more right there, that is a 16 delta. So if you sell the 16 delta, what you have left, the reciprocal of that is 84. So these, when we're selling options, a lot of times we'll call these probability trades. So if you were to sell that 1 standard deviation outside point, that 16 delta, you're basically starting this trade out with the 84% probability that the price at expiration will be below that 520 strike, which was the 16 delta short strike. So that's one thing, and so we call these kind of probability trades. So the same thing would happen if you sold the 16 delta put, that 480. So you have an 84% probability that price will be above 480 at expiration. So when I look at standard deviation, I always tell people, clients and members, that just think of it as a normalized move. So if we have 1 standard deviation, here to 520, then a normal move, it could go to 520 or it could go to 480. So when we're selling options, we want to start out typically at least 1 standard deviation out. And so it gets up here and then, bounces around. So this is where we can then, kind of put these probability statistics together to look at the probability of a trade if you're selling or buying options. So that's the first place that we start on any option, any trade when we're using options. We want to know what the probability is, for that. If we do a long call or a short call, what the probability is to hit our targets up or down. And that's the way that we're going to back into it using these kind of statistics. So here's a good example of option delta and those trade probabilities. This is the Thinkorswim platform. So in this example, you see it's Apple, and Apple's trading at $190 basically. So if you look at delta, and then you've got this other column here, it says probability. That's probability out of the money. Now, if you were to look at Apple here, it's trading at 190. So we go down to this 190 strike. That's the at the money. And then you can see your delta here. It says 52.52. So basically what that tells you, one way to interpret that is that, and here's probability out of money, is you've got a 50-50 chance that either at expiration over the next 28 days when it expires, it's going to be either above 190 or below 190, basically 52% probability, 50-50. Now, here's what we really like to do. When you're looking at selling options or even buying options, you want to look at the probability of that price point, strike price, being hit. So let's say we go out to the $215 strike here, and you see the delta showing a delta of 0.05. All right, so a couple ways to look at that is if you were gonna buy that option, the 215 strike, you can see that the bid ask here is 26 at 32 cents, or let's say you could buy that for $28 for one option contract. But the reason it's cheap is because, see that delta says 5? That basically backing into that, that means that theoretically you only have about a 5% chance, 5% probability chance that price will be at 215 at expiration. Now, the other side of that coin, the probability out of the money then is the reciprocal of that. So you take that 100 delta, you've got that 5 delta. So the probability is 95% probability that it will be below 215. So you can see then if you're buying or selling options, this is a great way to, or a great place to start to just kind of measure your probabilities. So, in this example, you can see, okay, well, if I bought that 215 strike, I can get them cheap. Well, there's a reason, because you're taking a lot of risk, right? If there's only a theoretical probability of 5% chance to get there, then you've got a lot of risk. And so, you're going to get a big reward if it does get there. So those are things we look at first off on any option trade, either buying or selling. We want to know those kind of probability statistics. So then by using these this kind of analysis, it's going to provide you a very useful tool for determining your price targets to trade against, and it's going to be free on most platforms that you're using. So based on this kind of math of probability, you're going to see that approximately 70% of options that bought are going to expire worthless. And based on this, it's a good idea for all traders and investors to consider selling options just as well as just buying them. So so by adding an income option type selling strategy to your trade portfolio, it's going to really make a dramatic and positive difference in your overall trading performance when you're using these things correctly. So again, remember, trading is a business of probabilities, and then to become successful, controlling that risk, incorporating high winning probability option strategies is really what's going to help you win the game. So that's what I'm always looking for, at Power Cycle Trading. We're always looking for high probability, kind of low risk type trade setups, and we'll talk about a lot of those here today. Now, step 4 then is selecting the right option income strategy. And again, in my opinion, one of the major goals for every trader should be to select trades that are going to be based on what's going to provide you the most consistent positive return with low defined risk, and not always that big, great kind of home run hit. So that's what I'm always looking at, chipping away, hit singles, doubles, and occasionally one of these option trades will turn into the big winner. So we want to just kind of keep that consistent game plan. And that's what we can do with the various different option strategies, and these kind of strategies we'll talk about. Now, one of the best ways of doing this is to understand that what are the different option income strategies out there available to you, then how do they work, and then you want to select the one that might be best suited for your trading style, the market environment, time to trade, your risk profile. So let's take a look at a number of these different strategies, and we'll go through a few of these here today. So here's some of the top ones. So we have what we call the covered call, and then we have what we call the protective collar, which adds actually a hedge to doing a covered call. Then we have the vertical credit spreads. We have what we call the iron condor, the butterfly spread, the income calendar, and the counter diagonal. So we're going to talk about these 7 here today, and then we're going to focus really quite a bit more so on the last 2, the income calendar and the counter diagonal, which are 2 really dynamic, unique strategies. So first off, the first one is what we call the covered call. Many of you may have already done covered calls, and these are pretty cool strategy. We just did a course not a couple months back on covered calls using synthetic options, which was pretty cool. So if we have time, we can talk about that a little bit later. But the basic thing is covered call. So when we look at the covered call, it's basically a kind of a longer term growth income strategy that can be used by investors and even institutions for their clients. So it's kind of the most basic income strategy, yet it's highly effective for bringing in weekly and monthly income into your trading portfolio. Now let's say, Joe, he owns 500 shares of XYZ, and he bought those shares for $40. Now he's tired of just getting kind of an annual dividend, which is about 2.5%. So he wants to earn more on that stock, and so he's heard that you could do this covered call strategy by selling calls against it. So let's go through how this works and see what Joe does. So on the 12th of June, Joe goes out and he sells 5 July monthly call options with a strike price of $42.50, and he receives $1 for each strike. Now remember, he's long the underlying stock at $40. So by doing 5 of these contracts, getting $1, he just brought in $500. So remember, one option contract's equivalent to 100 shares. So he just put in his pocket into his brokerage account $500 by selling those 42.5 calls against his $40 stock that he owns. Now this would be like over a 6-week period, about 2.5% return. So Joe looks at that, he's in love with that. This is a lot better than just that annual dividend. But the great thing too is he's not only going to get if he keeps the premium, he gets that 2.5%, but he still keeps that premium or the dividend income that he gets at 2.5%. So he's really, had a big effect on the revenue he's bringing in. So here's what it really basically means. So what Joe has done is given the right to the buyer of those call options, is given the right to them to buy that stock on the 3rd Friday of the month, okay, or before at $42.50. So these are what we call American options. You can, exercise them at any time before the expiration. So that's what he's done. So Joe has given the buyer of those call options the right to buy them if he wants to at $42.50. Now this is what happens. So at expiration Friday, let's say the stock was now just trading at 42. So Joe owns the shares at 40. He sold the 42.50 strike, but now the stock going out at expiration is only $42. So it's below his short strike. So the options that he sold short at the 42.50, that premium he brought in, the options are going to expire worthless, and so he's going to get to keep that premium. So he just got to pocket that full $500 from selling those call options. So he's pretty excited about that. But what if the stock had gone to 43, above his short strike? Well, there are a number of things you can do. So you don't want to panic. Just want to understand what are your options for that if that happens. So he could have easily bought the options back. Say he bought back the the day of expiration. Let's say the price had deteriorated, quite a bit. So he may have been able to still buy those options back for maybe around 50 cents. Remember, he sold it for $1, and maybe now it's decayed enough that he could buy it back for, let's say, 50 bucks. So if he bought it back for 50 cents, he just made 50 cents on that position. So that $1 strike price, the dollar that he brought in, he sold back, he bought back for 50, he made that 50 bucks. So instead of that 2.5%, he just, did 1.25% over that 6-week period. And annualized, that's going to be around 10.8. So he's still really happy, with the outcome of that trade that he put on, that covered call. Now, the next thing is, if you look, as long as Joe owns those shares, he can just keep doing this, selling these options for the next week or month and repeat the strategy over and over. So this is the main concept, collecting that rent or income on those weekly by using weekly or monthly options. Now, one thing to remember to point out that when you look at covered calls, a lot of times the market participants, people think these are, low risk type trades. But you've got to be careful, because if if the market collapses and goes that way down below your stock price, then you get turned upside down. So that's the big disadvantage for covered calls. Now, they're great if you own stocks that you don't want to get rid of, you just keep selling premium, things like that. So there are a number of things you can do, but this is kind of the basics of how they work. Now, the next thing, though, is you can do what we call the covered call with a protective collar. All right, so this is a really great way to kind of protect your downside if you do cover calls. So we're going to build on that covered call example. And so here's how it works. When a stock with a covered call drops in value and you own a put to protect it, to protect those gains against the downside move, that's what we call a protective collar. All right, so pretty easy to set up. So this is the protective collar strategy. So what it does basically is combining two strategies together. It's going to have the protective put plus the covered call. Now that protective put, or sometimes you'll hear it called the married put, what it does is it involves being long a put option and at the same time long the stock. All right, so you're long, let's say you're long that stock here at, let's say, $100. Okay, and then you could buy a put below it. Let's say you buy the put down here at 50 or something like that. All right, so you're long that put here, and you're long the stock, and you're long that put here. Okay, so if you buy a put, if you want to go short, you can either sell calls or buy puts, right? So you buy the put out. Now the other side of the trade is you have the covered call on, and that involves also being long that stock. So let's say you're long those shares still at 100, and then you're short a call above it. Okay, so let's say you're short that call at 150. So that's the collar, that's protective collar. So you're short that call here, long that put here, and you're long the shares here. So you've got this downside protection. So when you're combining those two strategies together, this is what we call the protective collar option strategy. So you can, do this strategy to protect specific stocks, ETFs, or even a total trading portfolio. Now, when we look at the protective collar strategy, what it does, here's the basic fundamentals of how it works. So think about it. If your stock goes down, the value of your call options that you sold short up here, so that you're short those calls, you're long the stock. Okay, so if the stock goes down, you're losing on the stock, but the call options that you sold, you're gaining value. They're allowing you to buy back those call options at a cheaper price, giving you a profit on the short calls that you sold above your long shares on that covered call. Now, most likely the call options would expire worthless, unexercised, at the expiration, so you keep that premium. So that's your upside kind of hedge. So remember, you sold the call options at a higher price than the stock that you own. So you say you own the stock at 100, and you sold those at 150, didn't get up to 150, you keep that premium. Even if it goes down, you keep that premium. So that's going to offset part of the cost or the loss you might have market to market on the long shares. Now the other part of it is the value of the put. Now if you're long a put and the market goes down, what happens? That put value goes up, all right? So you're long those puts, let's say at 50 bucks, the market goes down, the value of those puts are going up. So the value of the underlying stock goes down, the puts go up, the call options, basically you sold short, you get premium price profit in that. So those two are offsetting a big part of the long shares. So you can, structure these kind of protective collars, for different break-even points, different, places to hedge that trade. So here are the details. Let's go through this with the example of where Joe, with those 500 shares. So again, going back to Joe, he's got those 500 shares at $40 per share. Now on the 16th of June, the stock was trading at about 45 bucks. He bought at 40, now it's up to 45. But he wants to kind of lock in, temporarily hedge that position, lock in some of those profits and gains due to the overall market uncertainty, volatility maybe creeping back in. So he doesn't want to lose out what he's already kind of captured and gained. So what he does, he goes out and he buys 5 July monthly puts on XYZ. All right, remember again, one option contracts equivalent to 100 shares. And he bought those 5 monthly puts at a cost of $39. And he, not a $39 strike, and cost him 90 cents per option contract. So he's got the $40 stock here, and he's got the puts that he bought down here at 39. So right below his $40 cost here, he's got some puts that he bought for protection on the downside. He paid 90 cents. So that's his insurance premium, 90 cents or $90. So that's going to insure him to kind of cap his losses at 39 by doing this kind of structure. All right, so let's take a look at the cost of implementing this collar. All right, again, so he's got the shares 500 at 40 bucks. Then he bought the 39 puts and he paid 90 cents. And then he sold the 49 calls above and he brought in $1.10. All right, so if he did that, so he's long the shares here at 40. He shorted, it was trading up at 45, remember? So he sold above that. The 49 strike calls there. So he short those calls at 49. And then he bought below that the 39 put, okay? So now he's got that collar. He's short the 49 call, long the 39 put, still long those shares at 40. So going through the math here, he's got then a credit basically of 20 cents per share. So he sold the $1.10 on those 49. He bought the $39 put 90. So there's your 20 cents, on it per share. So his break even then would be 40, his stock price less that 20 cents, so 39.80. So he's got a pretty tight little stop there. Now the max profit's going to be the 49 bucks where he sold those calls to the upside. So he's going to get all the profit all the way up to 49. Then if he keeps going over 49, he's capped. He's not going to get anything else, but he's happy with the return he gets if it just goes to 49. So if you look at this, he's got those 5 contracts times 100 to make it an option, into option equivalent. $49, he sold that upside call plus the 20-cent credit, for doing the collar, less the share price. So if it was to close at 49 or higher, he's got 4,600 bucks, or that's a 23% return. So he's got that kind of cap locked in right there. If it goes up, he's going to get that kind of return. Now, if it goes down, he's got the downside capped at 39. So he's got the shares at 40, less the cost of those, the $39 puts and the credit cost here. So that turns out that he would have a potential, 80 cents per contract, or $400 potential loss, or 2% loss on his overall $40 share. So he's got a potential downside capped at about 2% to the downside, which is, totally manageable. He's happy with that. And the upside at 23%. Now, if he didn't do anything, it could go down to 0 and he could lose a heck of a lot of money. So it's a great way to structure these trades doing this kind of protective collar. So that's a really good strategy that you can incorporate. Now, the next one we'll look at are the vertical credit spreads. So these are very popular, and what they're going to help you do is alleviate having to own the underlying shares, which could be, pretty bad if the market goes down. So you're going to do credit spreads. You're going to cap your risk upside and downside with these credit spreads. So there are going to be the three basic types of credit spreads that you can use. And these are what I call probability trades. We're using those probability statistics. And so there's one that's called what we call the bear call credit spread. There's the bull put credit spread, and then there's the long iron condor credit spread. So when you combine these two together, we're going to create what we call that iron condor. All right, so we'll go through these. Now, before we get any further, though, I'm going to be doing a class on these, next week on basically the calendar and calendar diagonal, which we'll get into a little bit later here in this presentation. But before everybody takes off, I know a lot of you might have to go out and do errands or maybe take off early, but I want to give you this potential nice offering here. So if you want to join me next Saturday, the 25th, this workshop will start at 11 a.m. Eastern till 2 p.m. or however long it takes. And then we'll finish up Tuesday, the 28th. So next weekend is also Memorial Day at 4 to 5 p.m. Eastern. And then we'll do a follow-up Q&A. So if you sign up today, you can get the course and all the bonuses for $167. So the course value will be $197, but for today I'm giving a 15% discount. So if you use the promo code CAL15 small cap, you're going to get 15% off this $197. So your price will be $167. So that's basically a 92% course package discount. So I'll show you all the different bonuses. You've got a lot of things that I add to the course to help you be successful with these trades, but that'll be the price for you today. And then if you want to combine this with what I call package 2, this is with my alert service, which we'll talk about a little later. That price is $597, but with the discount price today, it's $507, and there's a 2 pay there. So with this, you're going to get the live course, recording of all that, the indicators that you'll see, all the bonuses. Now with the alert service, I've got 5 different alerts that I send out, so you get all 5 of the alerts services for 4 months, and then you're going to get the trading club also for 4 months. All right, so use that special link there. If you click on it, I'll show you what it'll bring up. Let's click on it real quick here. So go to this link, click on that. All right, and then you're going to see use the CAL15 right down here. All right, 15% off, and then you'll see here the course package 1. You'll see everything you've received in that. So the course will be, my time in putting together course. The value is $1,600. The course is $197, but then I want you to have these software indicators, which we're going to use for the course for helping us set up the trades. So here's my stock reversal indicator. These are, on my website, this is what the cost is on the website. It's $197, my extreme range band. So you get these 2 indicators as the bonus. Here you get my Fibonacci price target mapping course as a bonus, because I always use this Fibonacci target mapping for our targets. So you get that as part of the package. You'll get a 30-day trial membership to my trading club, which hopefully you'll stay with us, and it's $97 a month after that, or you can do different types of price subscriptions on that. And then we'll do a follow-up Q&A, and then you're going to get my option trading tutorial, another option course on Greeks and Delta, things like that. So the full bonus package, you get $1,185. So full value is $2,785. The price today is $197, but if you use that discount code, you're going to get it for $167. Okay, so just put it. Let me go through. I'll show you. Just click on this link here, buy now. And then put in your, you'll see everything listed that you'll receive, and then put in that promo code CAL small cap 15 for that 15% discount, and then apply. So you'll get 167. If you want my indicators, more of my indicators, you'll also see you've got an upsell. If you do want the indicators, they're 195. So that's what you do there, and that'll be package 1. Now, if you want to add it with the alert service package 2, this will give you all 5 of my trading alerts for the next 4 months. You can stop and start whenever you want. So if you go on vacation, you can stop, or business or whatever. You don't have to be charged for that time. And then you get 4 months of the trading club. And then you get everything in course package 1 at 197. So this full package here is 597, but with the discount today, it's 507. So we'll talk about this a little bit more, but I want to make sure everybody had a chance if you wanted to get that discount today. So we'll go through this a little bit further down the road, but my summary of all my alerts since starting this back in 2018 through Friday, we've got a 79% winning rate. We've had 730 trades closed out, 527 been winners, 47 break even, 156 losers. So this is a combination of 5 different alerts that I send out. And so you'll get all 5 of those plus everything in course package 1 plus membership to my trading club for the next 4 months. And so basically the different alerts that I send out will be selected butterflies and condors, counter diagonals, what we call monthly butterfly penning trades, selective earnings trades, and other breakout trades. These are typically credit spreads. So that's kind of a summary of what you're going to get there if you want the alert service added. All right, so put that in, and it's $597, and then you get this, put that promo code in there. You'll get this for 507. Let me erase this. And come down here, put in that CAL15 and apply, and there's also to pay if you like that. Okay, so that's just kind of want to flip through that quickly in case you have to take off early. And so this course will start then again, like I said, next week, next Saturday, and it'll all be recorded in case you can't make it. Yeah, it will be, Chet. It will be, okay? So that's what you can use there. So just use this special powercycletrading.com/special. Now, first, the bear call credit spread is going to be used when you think the market probably going to go down, but it can make money over time even if your stock does stay stagnant and doesn't go straight down. So that your stock can stay stagnant, and it could even go up some, and you're still going to make money. So basically, you're selling one call out of the money while at the same time buying another call with a higher strike in the same option series. All right, so that's a bear, what we call a bear call vertical credit spread. And so these have what we call a negative risk ratio. So again, these are what I call a probability trade. So in this example, let's say you sold the 1,020 short strike right here. So you sell that short. Okay, so that's 1,020. So you're short this call here. Now, when selling this call, this at that point in time had a 20 delta. That short strike, the 1020, was it going at a 20 delta? Okay, so that then theoretically, if you look at that, that's giving you a 20 delta. You have that delta like we talked about earlier of 100. You had a 20 delta short strike. So you're starting out theoretically with an 80% probability that the price at expiration will be below that 1020. So you're going to cap the upside risk in case it keeps going up. You're going to buy the 1030 call above it right here. Okay, so it's a $10 wide spread, 1020, 1030 spread with $10, or per option contract, that's $1,000 spread. Okay, now you receive that $200 credit. Your potential then risk though is the difference between that, and that's $800. So this would be also what we call the margin that you would have to put up in your brokerage account to do the trade. Now, if it closes below that 1020 at expiration, you keep the $200. And so then you can see return would be 200 on the 800 margin or risk would be a 25% return. So basically you're risking $4 to make $1. So this is what we call negative risk ratio. And if you're just starting out trading options or anything, you're going to say, well, why in the heck would I risk $4 to make $1? Because this is, again, what we call a probability trade. You're starting the trade out theoretically with a 20% or 80% probability that price will be below that 1020. So what we'll typically do is, what I like to do is, we'll do these credit spreads, but a lot of times what we can do is we might add a buy side. We might add a long component to the credit spread, and we can hedge back and forth. So we could maybe start out with a long call debit spread, add a credit spread, we create a call debit spread, things like that. So a lot of different ways that we can use this kind of strategy, not only use it at credit spreads, but combine it with other types of verticals. So that's basically what you're looking at there. Now here's a bear call credit spread example on what we call a cycle high reversal. So this is also what I like to do is not only have a high probability, but when we have a market cycle where it turns over or turns up, that's a great place to do these kind of credit spreads. So here's an example of one that we had on Tesla. So you can see Tesla had this really fantastic uptrend, right? Going up here, just really trending up. But then you can see it starts to kind of stall out here. And down here, this is the indicator you'll get as a bonus. This is called the cycle reversal indicator. So when this indicator flips down, that arrow right there, that purple arrow, that was the perfect place to sell an out of the money bear call credit spread. So we sold a short strike at 282.50 up here. Now, even if it turns sideways, we still have a high probability this trade will work out because of the theta decay, but it did, go down. So by doing the credit spreads with this cycle reversal indicator, this really increases our probabilities. So you can see that was just the credit spread there on the downside, but look here, here's one cycle reversal to the upside. So you could have sold a bull put credit spread here, all right, or a bull put credit spread here. So this is a great way to use these credit spreads. So that's kind of backing into it. That's kind of the initial setup here. So here's the Tesla short bear call credit spread. So this was on the 18th, and it was traded at that point in time at 265. So sold the 282.5 call along the 285. So that 282.5 call strike price, the short strike, was a 23 delta right here. Okay, so that'd be a 77 probability trade. If you want to look at it that way, by selling that 282.50. So we're starting out theoretical probability that it will close below that short strike, 77% chance. Now at 26, now it's traded at 244.50. So we had a nice trade, profit locked in at $50 per spread, 25% return over 8 days right here, okay? So it went from, we sold the credit spread at 50 cents, now that was worthless. So that's a, typical what a credit spread would look like. And, you can do these on, anything, SPX, bear call credit spreads on the index options, those are really popular to use, or, specific stocks. So the next one, though, is the other one is the bull put credit spread. So best used if you think the market's going to probably go up. But again, you can make money over time, even if the stock stays stagnant. So in this strategy, you're selling a put while at the same time buying another put lower, a lower strike in the same option series. So again, remember, if you want to go long using options, you're going to either buy calls or you sell puts. If you want to go short using options, you sell calls or you buy puts. So in this one, we're going to do a bull put credit spread. So it's a kind of a long upside strategy. All right. Again, a probability type trade though. So in this example, say for Apple, you're in this example, you're shorting that 149 put right here. So here's a short put, the 149, okay? And that put had a 20 delta, all right? So it's out of the money, it was trading at a 20 delta. So this gave you going into this trade a theoretically an 80% probability that price would stay below 149 at expiration. So you're short that 149 put, but you wanted to cap the downside risk, so bought the 144 put below it. And so you had your spread width of $5. You've received a credit of $105. So the spread was your risk between the spread of $5 less your credit. So your risk is $395. That'd be your margin put up. Now, if you kept the 105 at expiration, that's a 26% return. All right, again, a negative risk ratio. So you're risking $3.76 to make $1. All right, so again, these are trades that I like to also incorporate using our cycle reversal indicator to really give you kind of the better edge on the trade. So here's an example of one that we had on AMD. So this was a cycle low retracement reversal, and this is another bonus. This is my extreme range band indicator. These bands. So this will come with the course as well. So you'll get the reversal indicator and the extreme range band as a bonus to the course that I'll be doing next Saturday. But here you see AMD was coming down and came down to this kind of third band. It was really getting stretched, extreme band right here. So we'll go over how this is used in the course. So when it was, getting stretched here, you can see it had a cycle reversal to the upside. So when we had that reversal signal, that gave us a good, another edge to sell that probability to sell at the out of the money bull put credit spread. So a higher probability it was going to turn up. So that was the trade execution, why it was executed the way it was. So when that happened, sold the bull put credit spread. So here sold the 77 put short, right here, that 77 put, and then cap the risk to the downside by buying a 72 right there. Okay, so short the 77, long the 72. All right, so did that $5 wide spread and brought in $95 credit. All right, so that was going to go into the trade. That had the potential there to make, what is that? Make about 90, so that had the potential of 95 per spread on that risk. And that would be, let's see, the risk here, what was that? $5 wide minus 95. 95 divided by 405. So potential was 23, about 24% return. That went ahead and closed this out though when it was trading at a 4-cent credit. So bought that back in and made that $91. Okay. So that was a 22% return. But again, remember the probability on this trade increased because of our indicators giving us a cycle reversal. So that's kind of that combination there is kind of what I really like. So that was a, one kind of setup on AMD doing a bull put credit spread. Now the next one is the iron condor credit spread. So this is a combination of both the bull put credit spread and the bear call credit spread. So when used together, when you feel the stock is, more likely to trade, in a very tight range between the two short strikes and stagnate, this is a really great strategy. So it's ideal for premium collectors who seek to minimize potential losses in the event the stock then moves adversely either up or down. All right, so that's one that these are really popular and really great to set up. So it's going to also take advantage of your time decay and also that implied volatility crush, which both of those are going to go to zero at expiration. So here's what it looks like when you look at the risk profile. This is basically what you have. So let's say here you had a short call, bear call credit spread, and then you adding to it a bull put credit spread, right? Now you can do this all at one time, or you can leg into it. So a lot of times I like to leg into these. So let's say the market's going down, and it turns up, then you can set that bull put credit spread first. Then it goes up, starts to stall out, then you can set the bear call credit spread there, or the other way around. So that's a really great combination. So let's say the spread width is $4 wide or $400, and let's say you brought in $60 credit here. Okay, so you brought in $60 credit, so your spread width is 400. So then your potential risk or margin would be 340, right? The difference. Now if you kept the $60, that's going to be a return of 18%. All right. Now, let's say the other side, you were able to get $60 here on that put. So now you've got a total of 120. Spread width is still the same of 340. So your return would be 35%. Okay. So you can see the difference. So these are a great way to leg in, leg out, or just put them all at once. And if you have a range where you think the market's going to stagnate up or down, this is a great way to capture that premium and not have to be right on as far as direction. So here's an example again on Tesla, again on legging one on Tesla. So this one was set up where the first credit spread was done, where it came down here, it opened up hard to the downside right here. So we're looking for this move up. So when it opened up down here, set the bull put credit spread first. And then when it moved up later in the day, right here, then set the bear call credit spread. So you can see these lines show you where the short strikes of this both credit spreads were. So down here where it was trading here, we sold the 237.5 put and then bought the put below it. And then when it rallied up here towards the end of the day, we legged in and sold the bear call credit spread here. So now we have that iron condor structure right there. where we started off first with the put credit spread, and then when it rallied up, sold the call credit spread. All right, so that's a really great way to do these, kind of leg them. So here it is, the bear call credit spread, when the bull put credit spread first. So sold that. You can see this was selling the 237.5 on the 235 below it, $2.5 wide spread, brought in $60. Okay, so that was bringing in the $60 there. And so your potential here was 46. Actually went ahead and closed it when it got down to 14, just to close it out. So that was a $46 profit on the spread. So that's the 24% return. All right, but then this is what we did towards, on the bull put, but then it shot up and we sold the credit spread on the call side. So did that, and then putting the two together. So here's the call credit spread here. Received less on that $38 credit. And so that was a 23 delta short strike, 77% probability. But when you combine the two together, this is what we ended up with by doing this iron condor. So now we had a total credit of 98. Okay, so we had the credit from the bull put credit spread where we got the $60, and then we had the 38. Okay, from the credit spread on the call side when it flipped up. So we had a total of 98. Okay, so the potential profit here would be $64. On that credit spread. So that's typical of what you're going to make with these kind of credit spreads. So then it went out right there in the middle of the range. So it's kind of just ideal as far as you play in that range. So we had the call credit spread, first up the put credit spread here. Then it rallied up, sold the call credit spread there. So we had this, sandwiched right there with the total premium of $98. Okay. And so went ahead and closed it out, before that, just to make sure. But here you can see the credit of 60 on that put side. Bought it back at 4. So we had $56 here profit. And then we kept the full premium here of 38. Okay, so there's your total profit there of $91 on that risk. So that's kind of a typical bear call credit spread with the put credit spread, creating that iron condor. Now, the other one that's a really good one that's very, very unique and awesome that we do a lot of is the butterfly spread. So this can be constructed for a very low risk and high reward directional type or non-directional trade. So basically, this is what I like to do a lot, is where we have vertical credit spreads like we're talking about, but we combine and add a debit spread to it. I call it kind of the buy side, and then we've got the sell side. So we can leg in to these as well. We could start out with a credit spread, add a debit spread, and create a butterfly or a condor, things like that. So these are going to limit your profit, but also reduce your risk, and they're high reward type of returns on your capital at risk. So the butterflies are unique in that way. And so there are basically 3 striking prices involved in the butterfly spread. And these can be done using calls or puts. So typically, if we're looking for an upside move, we'll do a call butterfly. If we're looking for a downside move, we'll do a put butterfly. But again, with that sell side component, the credit spread side, we're taking advantage of that short time and volatility. But these will result in a net debit because it has a buy component as well. So here's what the typical butterfly looks like. This would be a balanced butterfly. So in this example, this would be like long a call, short a call, and then you short a call at the same short strike, and then you buy a call further out, same kind of spread width. So in this example, this was done for a maximum risk of $100 for the spread. So this is a $10 wide spread or $1,000. And we reduce the risk. We've only have a total risk now of $100. Okay, so potential to make $900 on that risk 100, that's a 900% return. So the butterflies are really pretty cool for certain situations to incorporate a butterfly strategy, into your portfolio. Now the next 2 are ones that I'm going to really talk about in more detail, and these are the 2 that we'll cover next week in great detail in the course. So this will be the income calendar spread And these are what I call flexibility trades. So the first one is you basically start with the income calendar, and then we can adjust that or make it into the calendar diagonal, or we have that flexibility. Then we can reverse these things and adjust these things to, we can do debit spreads, and we can do condors, we can make them into butterflies. We just have a lot of different things we can do. But basically what it is, it's a kind of a favorite medium to long-term non-directional option strategy. So the income calendar spread is a neutral strategy that profits when the underlying stock or security remains stagnant or trades within a tight range, like a credit spread you're doing. Now, the profit comes from the difference in the rate of premium decay and the implied volatility decay or collapse between the near-term short option that you're going to be short. So you're going to be short an option closer into expiration, short dated, short duration, and then long further out. Okay, so you still have a spread though, right? So this makes this work because the near-term option premium decays faster than the long-term option premiums. All right, so when would you use this? Great strategy if you expect a stock or security or trade to stay stagnant within a tight range, and it's going to produce income from that time decay. So the way that we use these is kind of a targeted range-bound trade. So I'll show you some examples. But I like to always, so when I set up any of these trades, we always use a target for the trade, okay? So these are kind of targeted range-bound trades. So the strategy is great for a condition when you want to keep that long-term position for, say, a stock or an ETF, and you're expecting at some point to break out either to the upside or downside in the future. So you can just kind of keep this and collect rent on it until it makes its break either up or down, whichever direction you're trying to trade. Okay, so this allows that position to get paid while you're waiting for that long-term part of the trade to kick in. So theoretically, the way it works, so we can use weeklies or monthlies, but let's say you had here, you're just playing the premium differential or decay. So in this example, let's say you go out and you buy 60 days out, you buy a $100 call. Okay, so you buy that call right here. So you're long that call $100, but then you're going to sell 30 days out closer in, you're going to sell a $100 call. Okay, so all you're playing is the premium differential between those two time frames. Okay, short the 30-day till expiration and long here. So the perfect scenario is if it doesn't move, it goes sideways, you're just collecting premium differential time decay from getting that higher premium from that 30-day call. It's going to expire faster, the time decay, versus the further out, which is going to stay, more intact and decay less. So that's the basic concept of that. And then we can, from this type of structure, we can do a lot of different things. But here's kind of the basic math of how it works. So let's say you went out and you bought your long the June 38 call. So that's going to be, further out, and then you shorted against the May 38. Okay, so that kind of looks like that graph there. So here's that June 38 call. So you're long that, and then you're short here closer in the May 38 right there. Okay, so if it doesn't move, you're playing that differential to decay. So these are open for debit, benefits from time passing and time decay, and then also benefits from what we call the volatility implied crush. And we'll get in, this is what we're going to get into next week, but this is kind of the basics of what we're going to be talking about today, and then what we'll do next weekend. So it takes advantage of your accelerated time decay from your option in the different time frames decaying at different rates. So that, an option contract with 4 weeks remaining will decay in value much faster than the same strike 8 weeks out. So that's the basic fundamentals of the spread. But then we can do a lot of other things with it. So here it is, just kind of simple math going through it. So you went out and you bought that 38 call, you paid $400, and when you put it on, that was $400, and you sold it against it. The 38 call received $1 credit or $100. So you can see your debit cost in is $300. Now the stock, trades sideways, and that's perfect. If it trades sideways, we don't care. We're just getting that premium decay here. So, towards the May expiration, that May 38 call is going to be lower in value from the time decay, lower than the June 38 because has a smaller time decay because it's further out time. All right, so at that point in time, let's say that June 38 call, then it's still trading right around 400, but the 38 call has really decayed in value. So now let's say it's only 50 bucks. So you can see your spread then has gone to 350. So we started at 300. Now the spread's at 350. So we just made $50 on our risk of 300. So we've got a 16.6 or about a 17% return. So that's the pure calendar just for the income side, but then we can do a lot of different things to adjust it into, directional trades and all kinds of really cool stuff, which we'll do in the course. So again, if you look here, this is some two big benefits, what we call the positive theta differential and positive horizontal implied skew, which we'll get into in the course. But here's just kind of to show you kind of a brief summary. So let's say you had that 73 short strike here, right? And you can see the theta on it is 34 cents, right? Now the series right behind it, that's the 28 Feb series, one date expiration. The series right behind it, same strike, 73, it's got a 16 theta, all right? So that's your positive theta. That's what you're playing there. So if it doesn't move the next day, you're gonna pocket that theta differential of $34 less 16. That's one part of your profit right there. If it doesn't move, you're getting that theta decay differential, and that's one of the parts of the concept. So you just pocketed $18 if you did nothing. And then the other thing is what we call the implied volatility skew. So you can see here, this series here is 92 implied volatility. The series behind us 87. So you can see it's a positive skew. So what you're basically doing, when you have higher implied volatility, you get higher premium. So this is going to have a higher premium in that because of that implied volatility being a higher skew. So anyway, don't get confused, but just kind of want to point that out. And that's what we're really going to be diving into that in more detail next week as well. So just kind of wanted to point that out. Now, the profit potential of the income calendar is going to be maximum profit when the underlying security or stock hits your strike price that you're targeting of the short dated option expiration. So here's an example of one that we've done here recently. So, and again, here's the summary of the alerts that we've sent out, that I've sent out over the for calendar and calendar diagonal since starting this service. So this was I started this back in June of 2019, and through Friday we've had 278 closed out trades. Either these are calendar or calendar diagonals. 203 winners, 14 break evens, 61 losers, runner at 78% winning rate. So these are unaudited, but these are summary of it, okay? So just kind of, these are high probability type trades, very selective, but we do a lot of these. So here's an example of a put calendar diagonal. This was on IYR, the real estate ETF. And so you can see here when we set this up back on the 10th, it was trading at 86.33. So here's what I call cycle high retracement reversal failure. So it had gone up to 618 retracement level here, and then it failed and was coming back down. So we were targeting a downside move to about $85. All right, so went out and bought the calendar, the 26 April, then short the 12 April 85 put calendar around 65 bucks. And then did an adjustment on the 12th, and then also some profit take. So it was hitting our 85.04. So here's, on the 12th, then we had a profit in the trade, and we also did an adjustment. Here's the profit though, first off, when we got into this on the 12th. So here's what the chart looked like, just kind of back into it. So it came up here to this area here, right there. You can see where it failed into these moving averages and then was coming down. Now we had a big support area right here at 85. This was like a 200-day and 150 days. So we were targeting that area right there. So we did this with the calendar, the 85 calendar. It made sense to do it. It was super cheap. So these are really low risk, cheap trades that you can set up. And then if we want to stay longer in it, we can adjust it to, different things. So here was that trade. So we put this trade on to a total cost of 65 cents or 65 bucks when we did it, targeting that 85. So we did the long the 26 April 85, short the 12 April 85. That's the calendar, cost of $65. Now that was on the 10th, and then here just 2 days later, it was now trading at 85.04. Okay, so this trade now was at $1.11. So now that spread had gone out to $1.11. Our entry cost was 65, so we just made $46 on that spread and 71% return in 2 days. But what we did with this one, we adjusted it for more of a downside move. But this was the first part of the trade. Okay, so a lot of times we'll adjust these to bigger to ride the trend bigger. Okay, so now the next one, this is the one that really is the one that we really try to usually get into. This is the counter diagonal. This offers a lot of flexibility. So this is another really great medium to long-term directional strategy, speculating on trend, and also good for hedging. So it's basically a vertical diagonal debit spread with the long option leg expiring set further out in time versus the short option leg, which is closer to time. So it's going to have a faster, theta decay, right? Closer to expiration, it's going to accelerate theta decay faster. So it takes advantage of that short-term weakness or strength that you think is going to eventually in time revert and cycle either back up or back down. And then, you can structure your trade accordingly. So for example, if you think that this trade is what we do, a lot of times we'll have, let's say we had a big sell-off and the market starts looking to bottom. Now, we don't know exactly sometimes when it's going to finally go back up, but we know it's probably bottom. So we'll do this trade to kind of, wait and get paid while we wait, and then it turns up. So we might, so we'll buy a call further out. So it's also sometimes called the poor man's covered call. So we'll buy the call further out and we'll sell against it a short call closer in. We'll just keep doing that until it breaks to the upside. So we do a lot of these types of trades. All right, so the trade takes advantage of the accelerated time decay characteristic of the front short dated option that decays at a faster rate than the back long dated. All right, they're very simple. Once you put a couple together, you'll understand how they work. Plus, any positive implied volatility difference between the two option series adds an additional, premium to you. So there's that additional vertical spread then component from this compared to the calendar. So this has a vertical spread component. That's why it's called a diagonal. So basically, I call it buying options at a discount. So the trade results also in a net debit. So here's just kind of a risk profile graph of what it looks like. So if you do, let's say you do a call debit spread, right? So let's say, so next week we've got, what is it, 24 May is the expiration. Next week, 24 May, okay? That's the option weekly series, right? So if you did a call debit spread in this series, long call, short a call, that's a call debit spread. And so you do it in the same series. But when we do the call, we do this calls or puts. So going up, we do calls, going down, we do puts. So in this though, in this example though, we would, let's say we go long the call, we go long that call further out. So we may go long this call out there. We may go, I don't know what it is, maybe the 5 June. I don't know if that's a series or not. But let's say we go long this call, the 5 June series, right? And we're pay $100 for that. And then, but we short, let's say we short the $125 call right here in this one in the 24 May series. So that's what we're going to, take advantage of. That short time decay is going to accelerate in this short duration. So that's the difference between that call debit spread, which is all in the same series, versus this where you're putting the long further out and the short closer in. So you get that benefit of that accelerated theta decay, keep that premium. So like the covered call, sometimes you'll hear this called the poor man's covered call, but instead of owning the shares, we're going to own that option contract further out in time, out there in June, and then we're going to sell the call against it closer in. All right, so we're going to spend a lot of time in the course showing you all the different variations and things we can do. So here are a couple examples of ones that we've done at the alert service. Here is one that we did not too long ago. This was on ExxonMobil. So it was trading at on the 5th around 105.80. So it was like, let me show you the chart so you can kind of see the concept of why we did this. All right, so here's the trade setup when we originally saw this. This is what we call a volatility squeeze. See its consolidation phase, really churning. And then we had our momentum indicators are positive. We had a cycle reversal back here. It's just starting to try to bottom. Okay, so we did this trade so we could, we could stay with the trade and work it up. But we're gonna, if it kept going sideways, we could keep selling premium against it like a covered call. All right, so that's kind of what it looked like going into the trade. So here was the alerts sent out. Okay, so sent this out, says new ExxonMobil long. It's trading at 105.80 daily plus 4-hour volatility squeeze, positive momentum. By one diagonal, I mean, that would be a counter diagonal, and this would be buying the 22 March, then selling the 8 March. Okay, so we're going to be long the 22 March, short against the 8 March, 106, 108 at that point in time, it's about $1.85. Okay. So then that was on the 5th, and then it popped up on the 13th right here. So we did an adjustment on the 12th. At that point, it was trading at 108.65. So we adjusted the trade for a bigger move to the upside. Also took profit, a little bit of profit the next day. It was trading at 109.95. And we did one more adjustment on the 14th and then profit on the 15th. Okay, so here are the adjustments in there. Let me see if I can read your question here, Ronald. So the underlying assumption that the 20 delta, 20 cents being reached. Yeah, so you have when you look at different, when you get the week of expiration even closer into the day of expiration, you have the other part of it is called gamma. So the gamma can totally change the delta that raises the delta. So again, the deltas are just a theoretical. It's where I always just start out. I don't rely on it saying that's the exact. So the question is, Ronald's pointing out that a lot of times you'll see these 20 delta 16. You use that as a probability, but at expiration, it's not. It comes right into your short strike, and that is totally. I agree. But the whole thing is just when you first start a trade, when you first start the trade, you want to give yourself an idea of the probability. Okay, so you just take it as a probability, and then you work it from there. So that's the way that you do it. You don't just, it's just not set in stone, and that's, say, okay, 20 delta is never going to get there. All right, so that's, so I agree with you, but it's a probability kind of a tool that you can use. All right, so here was the Exxon. So then on the 13th, we adjusted this trade, and then I'll show you the adjustment here, but we ended up, this was started out as that call counter diagonal 106, 108, and then it moved up, and we had this adjusted to, finally had this adjusted to the 107, 112. Okay, so you can see here, it's just kind of eye this. So we had the 106, then we adjusted, we rolled the spread up. Now we're going to be long the 107. We're locking in some profit. So we had originally the 106, 108. And then when the market was moving up, we adjusted up. Now we had the 107, 112. Okay. So just kind of outline that. And then these are a great way to work a trade to the upside and still getting premium while you're waiting. So then it started really moving up here. We did the adjustment here, and we did one more adjustment, and this trade was a super big winner. So here's just kind of outlining through it. So we started out on the 5th, it was trading 105.80. Then on the 12th, it was trading 108.65. So we adjusted this now to the 22 March 106, 110 call right here. And then on the 13th, now it was trading at 109.95. All right, so we exited some of the trade. It's trading at 364. Our adjusted cost is $1.79, so now it was up 185 per spread, or 103% return. Okay, so then we did one more adjustment because what we were just working this trade further up, just keep working it up. And we're getting premium the whole time because the market could turn down. So this is a great way to still, buy that protection. And then we did another adjustment here. It was traded on the 14th. It was trading out 110.41. So now we adjusted this. We're long the 22 March 107, but we're short now the 15 March 112. Okay, so we really had another nice adjustment to the upside. Our adjusted price was now $1.51 or $151 per spread. And now that spread the spread had blown out to 485, less our adjusted price of $1.51. So now we had a $434 profit per spread, 324% return. Okay, so this is a really great strategy, again, that I love to use when you think the market's bottoming or topping out, but you don't have to be precise on the exact timing. So just kind of back up here. So the concept here is that, okay, so we got in right here, which was a pretty good entry, with our indicators, but what if it just gone sideways for longer and then turned up? So then we can still take advantage of it. That's the beauty of the spread. All right, so like the covered call, you're long further out in time and you sell closer in, and you just keep doing it. As long as your support holds, you can do this over and over and over. Now, if it breaks down, that's where we use our stop loss. So if it breaks the key support, then we'll reverse out or close the trade out. But at some point, you can do these things with leaps, and we've done these with leaps. So if you've done covered calls and you've owned a stock for years, at some point you could actually literally amortize down your cost to zero. So that's the other thing that's so beautiful about it. You can amortize as long as it holds your key support area. Just keep doing it, amortize your cost down, and you can end up with a pretty big return, like in this one where your amortized cost goes lower and lower. So you can see it when we first started this trade out. We were in there $1.85, and then that was for a $2 wide spread. Okay, when we first started the trade, it was $1.85, $2 wide spread, and by the second adjustment, now we had a spread of $5 wide spread at $1.51. So that's where we're widening that spread out, but cheaper cost. Now here's another one that we did. These were a couple that TLT has been a pretty good one, but here's one, the same thing with TLT. And let me show you the trade setup first. So here was TLT right here, and we were looking for, what we're looking for is that kind of a bottoming here. See that bottoming out? Okay, so then we set the trade up here. It could have kept going sideways, but we thought there's a high probability it's going to bottom based on our indicators, based on chart pattern. So we did this TLT trade doing a call calendar diagonal. All right, so here was the trade when it sent out with the alert service, says new TLT long, trade at 94.35 daily plus 4 hour cycle low reversal, target 95 and 96. So this was buying a calendar. We started off this with a calendar at 95. So this was a 16 Feb, 31 Feb 95 call at 73, and then we adjusted it to a calendar diagonal. So on the 31st, so we did this adjustment here. So ended up with this adjustment where we were long the adjusted trade now. We were long now the 16 Feb 95 call and a half, short the 7 Feb 98. Okay. So we went from a 95, we rolled the spread down and did rolled it up. So we started out with a 95 calendar. And so this, we'll go through this in the course in greater detail. And then it was going up. So we rolled the spread up to the 95 and a half, the long strike, just a half a dollar more, and then widened it instead of having it as a calendar. Now we sold against it the 98 call with the 7 Feb. All right, so working the trade to the upside. And so this one it was one that we kind of worked it up to the upside, and similar to the Exxon trade. So that same concept, same kind of outline of what you're trying to do. So set it up here, did the adjustment here, and then started taking profit there. So here's the, ended up with this, started out with the calendar, Started out with a 95 calendar, and then did the adjustment, and now we're into the 95.5, 16 Feb long, short the 7 Feb 98. So we widened that spread out. We had that spread then reduced down to 91 because we took a nice profit from the first adjustment when the 95. So we had this adjusted down to $91, and the spread blew to 236. So we had $145 per spread, 159% return. And here's just one more. This was another one on TLT. Now this one was even better because this one really had a nice bottom. So again, you'll see the same kind of basic chart pattern for every time we do these. So, looking at kind of a bottoming here. Okay, so you can see at TLT, it sold off pretty hard. Then we had our cycle reversal, get good momentum. So we got into the trade here. Now it could have kept churning sideways, but our assumption was that at some point it's going to break up. So as long as it holds our support, we can just keep, we can buy further out, sell closer in, cover call, and then eventually get that break. That's what we're looking for. Whatever you want, Ronald. I'm just showing you what the alert service here. These are alert trades, so you can check it out if you want. So here was the trade setup, and so right here was the entry. So that was about the 1st of November, trading at 84.97, and then we did the adjustment on the 3rd. It was trading up at 83.30. So now we adjusted this to the 17 November 86 call, short the 10 November 92. So you can see we widened out that spread. And here it ends up, we had this thing adjusted down to $96 on the spread cost. Widen out the spread now, 86.92, 17 November long, 86, short the 10 November 92. And so that spread had widened out to 381, cost 96, 285. All right, so that's kind of a look there. And so, just kind of wanted to give everybody an idea of the different things you can do and advantages that you can get from, the different option income strategies that can, help you to generate income, reduce your trading risk, and play general trends, getting paid while you wait. But it was just kind of an overview. And if you'd like to, get into much greater detail next week, like I said, next Saturday, I'm going to be doing a option course on these two primary strategies, the calendar and counter diagonal. So it'll start next Saturday, the 25th at 11 a.m. Eastern. So we'll cover the calendar and the counter diagonal, and then with great detail. And then we'll do we'll do part 2 will be, since we've got a holiday coming up, we'll do that on Tuesday, the 28th from 4 to 5 p.m. So it'll be a 4+ hour calendar option trading workshop. Everything we've broken down, 30-minute modules or less. And so you're going to get, my 6 bonuses here. So the thing I want, the course itself will be $197, but I want to give everybody the indicator because this is going to really help you. This kind of a timing tool for timing bottoms and tops is what we use for these kind of spreads or anything that we're doing. And then for targeting, for price target mapping, when I set up any kind of option trade or any trade in general, I want to know, okay, what's my potential price target to the upside for profit take, or say a defense trigger target to the downside, things like that. So we'll use the Fibonacci course here, so you'll get that. It's based on Fibonacci and a lot of other things which we'll go through. And then you'll get a 30-day trial membership to my trading club, which you can then hopefully you'll stay in, renew and stay on. Or we've got other different subscriptions that you can do. We've got yearly or 6 months or things like that. So a lot of other types of you can do 97, or we've got a yearly, things like that. And then we'll do a follow-up Q&A. You'll get my option trading tutorial. So on the Greek, so you've got a total bonus value of 2,700 and 197, and if you use the Cal 15, you'll get this for 167. So I'll show you a couple more trades. We did a couple calendars, calendar diagonals last week, and I'll show you those in a few minutes. But want to get through the course details here, and then I'll show you one that we just did. We did Oracle. I guess we did Oracle on Thursday, and we took a little profit yesterday on that. That turned out really well. And then we did Exxon yesterday, and that we took a little profit yesterday as well on that one. That was a calendar diagonal. So I'll show you those two here in a few minutes. So if you'd like to sign up here, you can use this link here, or you can use, so pull up that, or you can use this specific link here. I'll show you the other ways that you can do it. So if you want course package 1, this will be course package 1 right here. So it's powercycletrading.com/1cal, or use that special link that I gave you. You can look through it and use that, or this link here, and you'll see that the price will be the same. Here, use this link here. Okay, if you click on that, should pull it back up. All right, there you go. And then, put Cal 15 in here, CAL 15, small cap. That'll give you that discount there. And so you'll get these bonuses. The course is 197 with all the additional add-ons there. And then if you want the alert service added to it, you'll get all 5 of my trade alert service for the next 4 months. And again, you can start, stop whenever you want at your own convenience. So if you're taking off for a week or 2 weeks for vacation or business, you're not going to get hit on your time. And then with this, you'll get my 4 months, my trading club. So everything, so the 5 alert services and everything in course package 1, all the bonuses that were included, that 197. So alerts on either butterflies or condors, calendar diagonals, butterfly pinning trades, breakout reversals. These are credit spreads, typically are selective earnings trades. So you'll get any of those. And this, if you want to do this package, you can still use that special that you can use. Again, you can use this link here that I gave you earlier, or I'll give you the other link that goes directly to it. So you've got a lot of flexibility there, and or you can just go here and there's a 2-pay, but again, use that Cal 15 for today and get that additional 15% off. Okay. Okay, so take a look at that now. Let's go through what you're going to get here. Again, you're going to get, with the alert service, you'll get everything in course package 1, but the alerts for 4 months, trading club follow for 4 months. All right, stop and start when you want. So typically 8 to 12 stocks or ETFs to send out per month. Selective either butterflies or long condors. We do a lot of those. The bulk of everything pretty much are calendar diagonals. We'll do, for very selective butterfly calendar, kind of what we call option pinning trades. I'll show you a couple of those that we did here recently. And then we do breakout reversal trades. These are typically credit spreads or, earnings trades, which are based on calendars as well. So when I send these alerts out, you get a trading guide, exactly how to do the trade. I do a setup video review after the close each day. If we did the trades to show you why I did it. Trades are listed in archives, and go back and check it out. Then we do a weekly Q&A, so you'll have access to that every week and for the next 4 months, live and recorded. I do a daily video newsletter follow-up every day after the close. And then you're going to have access to my virtual trading room, so you can come in every day during the week. It opens at 9:30 Eastern to 10:30, so every day, first hour of the trade. If you have any, anything you're looking at that you need help on, I'm there to help you on that, or anything that we're specifically doing. So come in for that, and then you'll get 60% discounts on anything that I have on courses or trading software on my website. So a lot of really good stuff there. And again, use that promo code of CAL15 right there today, and you'll get that 15% off. So let's go through a couple of more trades here. So here's the calendar diagonals. I showed you that earlier. We've had 200, these are unaudited, but 278 trades closed out since the June 2019, 203 winners, 14 break evens, 61 losers, 78% winning rate. And let's go through a few of these, and then I'll show you a couple that we just did actually last week. So here's from Pam, said, just send a quick note of thanks that you could maybe pass along to Larry for all the fabulous teaching through the years. I truly enjoyed learning from him and the other traders in the trading room every day. I don't think there's a better trader in the world when it comes to option spreads and other ways to trade than Larry Gaines. Appreciate that. So with the course, we're going to go through part one, the option selling foundation. We're going to go through the Greeks that you need to understand and how they work, such as time value, implied volatility, then the trading probabilities, how to use that probability analysis to understand what are your potential probabilities going into the trade. And this will be based on using what we call that standard deviation price forecasting, how option pricing works, the trading rules and timing of these types of trades. And then we'll get into part two, the basic income calendar. We'll start with that one, kind of the foundation of the trades, the basic income calendar, the benefits of the income calendar, characteristics of it, and then what I call the trading edge. First trading edge is time and theta, risk review of that, and then trade setup steps. And then part two will be when we get into really the what we call that calendar diagonal, or some people call it the poor man's covered call. I call it the smart man's covered call, because instead of using the option shares, we're using cheaper options further out. But these are just a fantastic strategy. Again, we do most of these are the ones that we do typically the most of at Power Circle Trading. So the basics of the calendar diagonal, the benefits of it, characteristics, how it works. So there's kind of two major timing edges. We'll look at the trading edge, time and theta. And then the trading edge two is kind of the direction. So we're going to use our indicators for that. Trade setup steps, how to make these adjustments, defensive adjustments, the resources used, and a really good trading library. So with the course, you're going to get these enrollment bonuses. First, you're going to get as a bonus my stock reversal indicator. And so this is available for Thinkorswim, TradeStation, or TradingView. Okay, so you can have one or all. And so it's got an upper and lower study, and so it shows you when we get the stock reversal. This is a really good timing tool that we use. So just kind of the basic, when we get a reversal here, start getting a move up. This might be when we want to put on the calendar diagonal or bull put credit spread or something like that. So you'll get this indicator as a bonus just to kind of help you, guide you through these trade setups, and I'll show you how it's used in the course. And then my extreme range band indicator, you'll get this indicator when markets are super stretched, overbought or oversold. It really helps to navigate, extreme ranges of the market. So it's got two what we call extreme range bands, up or down. This is for Thinkorswim, TradeStation, eSignal, or Ninja Trader. Okay, so again, this is really good for timing the market. So you can see here, this was just NASDAQ 100 QQQ. Came up to this kind of high end of range here, this kind of what the range 3, which is what we call it ATR. And then you can see we had a reversal here. So then it started to fail down. So these are great for credit spreads, or this would be, we would do a bull put. We would do here a put calendar diagonal for move lower, things like that. Here's a cycle reversal to the upside. So just a really good timing tool that you're going to get these two indicators. And then you're going to get my price target mapping course. This is based on Fibonacci, but also incorporates moving averages, price action, support, resistance, standard deviation forecasting, and unusual option activity. So this course takes you through and shows you how all 5 of these are aligned together to give really good profit targets or defense targets that we can use. So 3-hour recorded course here. So you're going to get that as a bonus course for this course. And then we'll do, if you do the package 1, you'll get a 30-day trial membership to my trading club. If you do package 2, the alert service, you'll get it for the next 4 months. And so this is, open, like I said earlier, we're open, trading rooms open from 9:30 to 10:30 Eastern, Monday through Friday. And I do a video newsletter update. Videos are archived. We do a Q&A usually every Tuesday, live and recorded. Good trader educational vault additional material there, and discounts on all courses and software on my website. I've got a lot of different trading indicators and tools. So you get all that with that, package 1 and 2. And then here, here's what's so true. Here's Jay, one of my longtime members, said, Reading books is fine, but seeing the actual option trade setups makes a huge difference. Thanks, Jay. And then 5, we'll do a follow-up Q&A, live and recorded. So this will, kind of help you if you have any questions coming up on this course or anything down the road. You can come into the Q&As and, fire away. And so plus you get that virtual trading room for 30 days as well. And then one last really good bonus, my option tutorial trading course. This is a 60-page option guide with videos covering mainly the Greeks, the delta, gamma, theta things, option pricing, market maker secret, standard deviation. So just an additional option trading, education there for you. And then here's the lead open and close alert service. So here was from Waleed, one of my members said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trades. Some are good, others are not that great. But one thing I'd like people on this webinar to know is that when I get a trade from Larry, I do it blindly as time is shown. He is dead accurate in his recommendations. Thanks for the service, Waleed. And here's from Dan. You're very diligent and totally thorough with your analysis. That is the foundation of success, your alerts. I paid for my subscription with the first 4 trades I took when I was just learning how to trade options. Please feel free to share. So that was really, really nice to get from Dan. And so here's what you're going to get. Again, you'll get the 4 months the alert service, all 5 services, 4 months the club, and then everything in course package 1, the live course, indicators, all bonuses, and everything here. So it covers a lot. Now, when I send out a guide, alert, some family members just want the trade setups because they're pretty high probability as far as the ones I select. But I always send out a suggested option trade if you want to take it. I'll give you the entry level, profit targets, any unusual option, based on that option activity, fib levels, things like that. What option series to use, stop loss levels, guidelines, and I'm constantly updating, during the day. Trades are listed in archive. We use a Telegram service, which is really, trades go out super fast. So as soon as I put the trade up, the trade goes out. So here's like what it looked like here on, here's one that we did. Here's like Oracle. This was on Friday, right at the end of the day. So we've gone long Oracle. Here's Oracle trade. We did the setup Friday right here. We did Oracle actually on Thursday right here. We did Oracle and Exxon. Let's see here. Yeah, we did Oracle here on the 16th. Said new Oracle long trade around 121.83. Trade set up to play a daily cycle low retracement reversal, positive momentum. Says buy here the diagonal. 24 May short the 31 May long, 24 May short right there. If you can see it, 122, 125, but then at $1.50. And then yesterday we had a nice move to the upside. I sent out an alert towards the end of the day. If you wanted to take a little profit and then hold the balance here, it says then Oracle long trade around 123.35. If long, that spread, multiple contracts, take a little off, hold into next week. So these go out within seconds. So constantly updating that. All right, so that's everything you'll get there. Now, here are a couple that we just did. Here's the trade that we did on Oracle. Let me pull that up. You can see it real quick. So this was a pretty cool. We'll see where it goes here this next week, but this was one that we did on Oracle. So here was the alert that was sent out. I showed you that earlier. So we did the 31 May long, 24 May short, the 122, 125 call calendar at 150. And then here was on Friday, it said currently up about 45 per spread, 30%, take some profit if you want. All right, so here was trade entry right there on Thursday. Then it was up here on Friday. So this has not a lot of potential upside for it. But here it was on Thursday, when I sent out the alert, if you wanted to take a little profit, it was up about $45 per spread, 46 per spread, or about 31% return. So this one, we have some good potential in it for hopefully next week. We'll see how it pans out. Let me maximize this. So we've got the next kind of target is up here, this Fibonacci level, that's 1618 up to about 125. So here's the spread currently. So we're long, 1 second here. Okay, so here's the spread that we set up on Thursday, long the 31 May 122 called and sold against the 24 May 125 at $1.47. So went out up, about 40 bucks. It was up 45 or so. Now, if we get a move to 125 next Friday, this has potential to be up about $190, $180 on that risk of 147. But the way that I love to trade these is that, so we're basically, if we don't get to our short strike next Friday, the 125, we'll close that short strike out. So we're short that 125 call right here, about 66 bucks. And if we don't get to 125, we'll keep the $66. That then will adjust down our long dated cost, which was around 213. So that reduced that. And then what we'll do is we can go out and we can sell the next week out. We've got the 31 long, so we could convert this to a call debit spread or something like that. Let me see, I can put in the 31 May here. And if we wanted to sell the 25 call on that, it'd be 124. Anyway, this is what I'll teach you in the course, all the different adjustments we do. So that was a really cool trade. Did that one on Thursday and has really good potential upside there. And then we had another one we did, this was on GDX, this is the gold miner stock. So we did this one on the 8th. It was trading at 34.30. And then we adjusted this into a long call condor. So this was the trade setup. So this one we set up originally doing the diagonal. So we were long the 24 May, short the 10 May, 34, 35 and a half, just $1.50 wide spread at $1.05. And then what we did with this was we ended up buying a close at 35 and a half call, sold to open the 17 May 35. So we adjusted the trade to the 34 call, short the 35 and a half call. And then so we're doing a lot of different adjustments based on where the market is, but ended up with this one, converting it to the condor. So we adjusted this, then we had we ended up moving this whole trade into the 24 May series. And so we had this long the 24 May 34 call, short the 24 May 36. That was on the 9th. And then on the 13th, we added the credit spread side and made this into a condor. So we adjusted the long call so we had the 34 May long, short the 36, and adjusted it to the condor. So we adjusted it to this trade here, what it looks like a condor here. Anyway, so it's kind of hard to walk you through it, but this is the one that we did on that. So it's trading right here. We adjusted it, got out right there. Probably should have stayed in, but this is what we ended up adjusting it to. So started out with a call counter diagonal and then adjusted on the 13th. It was trading 35.16 to the long call condor. So we're long the 34 call, short the 36 in that 24 May series, and then sold against it 37.39. So we had this condor structure for a total risk of $62. That's the max risk, and then potential return of 138 if it goes out in here. So we went ahead and took profit on it last week. It looked like it might top out, so we closed it out for a nice small winner. So this was up about $52. It's going out right there on the 15th. We went ahead and closed this out right there. So spread entry we adjusted it to $62 debit at $1.14, so $52 per profit on that. So these trades are, always try to make everything super low risk but high return type trade setups. So that's a look there. And then here's some butterflies that the alert service has done. We do quite a few butterflies. We've started this one back in 2019. We've had 165 closed out, 116 winners, 11 break even, 38 losers, 77%. Now, some of these are 2x to 25x potential returns. These things can be super big winners. And so here's one that we did just last week on Dow, and adjusted this to a call butterfly. So when we set this trade up, we did this as a call debit spread, and then we adjusted this right away on the same day to a butterfly. So we'll do it a lot of times. I'll do it, kind of this way. So we bought the 58.60 call debit spread at 75, and then later in the day we ended up selling against it the 60.62 call. All right, so now we have the 58.60.62 call butterfly, and then we took profit on it 16th, and then went super low risk trade here. So here's that one that we did. So set this up here on the 8th, and then we ended up adjusting this to butterfly there on the 8th, and then we got out to right here on the 16th. All right, so here's the spread trade setup. You see the risk profile here, potential reduce our risk down to 47. All right, so we had the 58.60.62 call butterfly, $47 of risk, spread width 200 less our risk, so potential to make 153. We ended up closing out there on the 16th for smaller profit, but pretty decent return anyway. So got out here, it was trading at 59.21 right here. So we went ahead and closed it out. It's trading right there. So spread went from 47 to 117. So we're up $70 per spread. So that was the Dow trade. And then here's another one we did alert service. This was a broken wing long call condor on Microsoft. And so we set this one up on the 14th of March. It's trading at 423.70, and ended up taking it off on the 22nd. It was trading at 428. So really nice return here. I won't go through all the details, but here's the basic setup. We set this up here as what we call a volatility squeeze breakout, and then we ended up getting out here. So here's the trade. So we did this as what we call a broken wing condor. So we were long the 422.5, 425 call debit spread, $2.50 wide spread, and then we sold against it when it was running up to 435, 440, so $5. So this is, what we call that broken wing condor. So we had a little bit more risk if it went up, but we weren't worried about that. And the downside risk, we had to adjust this trade to $47 cost right here, 47 to make potentially 203. Okay. So 431% return potential. That doesn't mean we're going to get it, but I always look at the risk reward to go in to see if it's worth doing it. And then it went out right here. So this was on the 22nd, trading right where we want it, right in that range. So it went from 47 up to 250. So it's up 203 or 431% return. And one last one that I wanted to show you. So these are very selective. This is what we call the lotto trade. So here's one that we did. These are really exciting. This is a butterfly. This is the pinning part of the service. So this was a long call butterfly pinning trade that we set up on Tesla on the 8th of February. It's trading at 189.35. And we were targeting based on option activity, some other things I look at. I sent this out to the alert service members. We were looking for a target to 200, all right, at expiration on the 16th. And this thing pinned to the penny at the 200 strike. So it went from, it had a spread profit of $231 per spread. That's 1,925% return. All right, so here's all the detail on it. I won't go through the whole detail, but you can look back later. Here I'll just show you here. So this was doing the 197.5, 200, 202.5 call butterfly at 12 cents, $12, okay? That's why we call it the lotto trade. And this thing ended up going out perfectly, pinning at 200, which is pretty amazing. I've never really had one that did it to the penny. So we set this trade up right here on the 8th, targeting this 200, and the expiration, it pinned it perfect. And here's what it looked like, the potential on the trade. Looking at the profile, this was the 197.5, 200, 202.5 call butterfly, $12 of risk. This was sent out to the members. So spread width of 250 less your cost. So potential to make 238, that's 1,983% return if that happened, right? Which it may not, but if it didn't, you lose 12 bucks on one butterfly, or that's, what is a cup of coffee at Starbucks. And then it went out almost to the penny, or it did go out to the penny right here at 200. So this was on expiration. It was trading right there at 200. It was up $231 per spread, 1,925% return. All right, so anyway, these are some of the things that you'll get from the alert service. Just kind of give you a sampling there. And any questions on anything? So use that link here. The easier one to do, if you want, is just use that special link, powercycletrading.com/special. Let me put that up there one more time. And then feel free, any questions, let me know. And this will be good for the next couple hours. You can see there's a countdown clock. Okay, any other questions here? Let me make sure I'm not missing anything. All right, so the course will be, again, next Saturday. We'll start at next Saturday. Let me show you the course time and everything right here. Okay, so we'll start next Saturday, the 25th. And if you can't, make it live or miss part of it, it's all recorded, 11 a.m. to 2 p.m. Eastern. And then we'll come back Tuesday after, I guess, the holiday on the 28th, and finish up that afternoon at 4 p.m. to 5. And then we'll do a Q&A the next day. So you'll get everything here, all the enrollment bonuses, course, everything. And if you use that CAL 15, you'll get that extra 15% off. All right, really appreciate everybody being here. Any